Assalamu alaikum, and welcome to the Oasis Focus on Finance show, the show with an empowering approach to growing and managing your wealth. As we discuss those important investment matters that you need to address on your path to financial freedom. Thank you for your comments on last week's show, much appreciated. Should you wish to ask any further questions or want us to address any issues pertaining to investment and savings, feel free to contact us. Our SMS line and email address will be on screen during the show. On today's show, I'll be talking to Hassan, Motala and Isma-el Ebrahim, Oasis investment analysts, as we have a look at the world of financial markets. During the past few programs, we touched on the South African and global economy. We also discussed that the developed world was more robust, but that the developing world, such as South Africa, was facing short-term headwinds. So today in studio, we have with us Oasis investment analysts Hassan, Motala and Isma-el Ebrahim. Gentlemen, assalamu alaikum.
Wa alaikum salam.
In previous programs, as we said, we've discussed global and local economies. So Hassan, let's start off with you. How have financial markets been facing up to all of this in the past few years?
Sure. I think, Shafiq, it's always good to obviously put it into perspective. Now, you have heard my CEO, Mr. Ebrahim, and also some of my colleagues speaking about the economic environment. And it's been obviously, we are facing a relatively tough environment, particularly in the emerging markets, but you've seen a robust developed economy. However, remember coming out of the financial crisis in 2008, what we had was an unprecedented amount of quantitative easing that had taken place. Now, for the benefit of the listeners, what is essentially quantitative easing? Is basically speaking where you've had this influx or supply of money into the economy to basically boost demand. And it's basically what you're finding is it has driven interest rates to levels we haven't seen I think we've never seen levels that we have seen in the last number of years. So you've had quantitative easing programs implemented by the US, Europe, Japan. So it's been by the major central banks throughout the world. So you've had this major influx of cheap money coming into the system. Very importantly though, what it does though, it creates and boosts investor demand. So what the result is, you've got this cheap money coming into the markets, it's boosting investor demand, and that money now has to find a place to be put to work. With the result, what has happened is, you've had this money going into stock markets, you've had it going into bond markets, you've had it going to a variety of investments over the last number of years. However, what happens though is that you find that the money also tends to chase higher risk type of investments as well. And what we have seen during this period is that the higher risk type of investments have actually benefited the most from these programs over the last number of years. So with the result, massive amounts of money going into higher risk, highly geared companies that have benefited from that. And with the result, your lower quality, higher risk companies have actually done a lot better than the higher quality companies during this period of time.
Now Ismail, now we're seeing monetary conditions normalizing, especially in terms of interest rates starting to rise. Your take on that?
Shafiq, I think it's always helpful to look at an illustration. So for ease of reference for the viewers, I think we should look at an example and I'll talk you through it. Now Hassan just spoke earlier about going into an environment where we will see interest rates rising. And in the past you've had many companies, he alluded to poorer quality companies benefiting from a lower interest rate environment. If we look at the example coming up on the screen shortly, you'll see that let's take for example company A and company B, and ignoring everything else and ignoring taxes for this purpose. Now both companies, company A and company B, have a funding requirement of let's say 500 million rand. And we assume that they earn an operating profit margin of 10%. The difference between the two companies is that company B has a 50% debt requirement. So of its total capital structure, 250 million is taken in debt. Now it has to pay interest on that debt. So at the moment, in a low interest rate environment, let's use 5% for example, that company is paying 5% interest on 250 million rand. So if we look at the profits, it's slightly lower than the profit being made by company A. But if we look at the return on equity, the return on equity is slightly higher at about 15% or so. Considering that we expect interest rates to rise going forward, let's look at what company A and company B will look like if interest rates were to double. So we're going from 5% to 10%. Now you'll see that company A, which had absolutely no debt, has consistent earnings. Its earnings continues to be 50 million rand. If we look at company B now has to pay interest, higher interest, so a greater proportion of its profits are going to debt funders rather than equity funders. The important point I'd like to highlight here is if we look at the bottom line, if we look at the earnings, firstly, the return on equity has dropped to 10% from 15%. And secondly, you can see a 33% decline in earnings. Now, most investment analysts will tell you that share price performance or share price appreciation is largely one of the drivers is earnings growth. So companies with debt, with a significant amount of debt for that matter, are going to face a headwind of a rising interest rate environment, and that's going to make it more difficult for them to see earnings growth, which will affect share price appreciation. So from Oasis perspective, we like to focus, we believe it's going to become increasingly important to differentiate between higher quality companies and those poorer quality companies that have significant debt, and that's a key factor for us.
So how does this impact on financial markets and investment portfolios?
I think from a financial markets perspective and investment portfolios perspective, we believe that there's still opportunity, there's still significant opportunity. And we believe that that opportunity sits with higher quality companies rather than lower quality companies. So we believe over the next few years, lower quality companies are going to underperform. And if you ask me, how do we differentiate between a lower quality company and a higher quality company? Any valuer will tell you that in order to value a security or to value an asset, you need to value a stream of cash flows. So higher quality companies are those companies that can generate sustainable cash flows going forward. I'll give you an example. You know, we've been looking, I think last year we mentioned Pallinghurst. We'll show you the share price performance in a minute, but you can see that that company has significantly outperformed, both relative to the Aussie as well as the resource sector. And so how do you differentiate a higher quality company to a lower quality company? We believe, firstly, you look at competitive advantage. What is that company's competitive advantage? Does it have a higher quality asset relative to its competitors? And then you also look at factors like management. What is the quality of management? So we'll use Pallinghurst also as an example because I think it's done outstandingly in the last few years. And if you look at Pallinghurst, so firstly, it's got assets that are low cost, shallow resources, and very long life. And most importantly, it's much less dependent on electricity relative to your conventional underground mining, which is prevalent in South Africa. Secondly, if we look at management, it's chaired by the founding CEO of BHP Billiton, which is the biggest mining company in the world today. It's also got shareholders of the like of Christo Visa, as well as various sovereign wealth funds. So this ensures that it's got a knowledgeable shareholder base, which ensures that management manage the company prudently, and they've actually allowed them to ensure that management take an approach of less debt. And you'll see that today they've actually have a huge cash pile relative to most of its competitors, which is suffocating in debt. And then thirdly, it's also got its underlying investments are spewing cash. If we look at a company like Gemfields, which it invests in one auction of Gemfields, what Gemfields is trying to do is they're trying to do to gemstones what De Beers did to diamonds. In one auction, they paid back for a mine. So that company is generating significant cash flows. And then finally, if we look at volumes, you can see the share price performance. The volume graph will come up in a minute. But if you look at how they've ramped up volumes, that's upheld the share price, which has done it very well. And we believe that going forward, volumes will continue to run as they bring in more gemstones into the market. So going forward, we think Pallinghurst will continue to do very well. And it's an example of a quality company.
Hassan, are we dealing in a climate where we're looking at fundamentals and quality as opposed to that market word sentiment?
Sure. as we've highlighted, you've had that environment where you've had the cheap money, you've had that influx. And with the result, that sentiment was a big driver. The high risk companies benefited substantially. But as Isma-el highlighted, as interest rates start to pick up, there's going to be a key focus on fundamentals. That example we used of as rates move up, the impact it has on the bottom line. As people start to see and investors see that earnings come under pressure, fundamentals do take place and are very cognizant of that in terms of driving share price performance. We are going into that environment. And we are focused on investing in those companies that have cash on their balance sheets, have good cash flows, and very importantly, can drive long-term earnings growth by having sustainable business models. And that's going to come through. You're going to see it. This environment over the next few, we've been through different cycles over time, various cycles. And you'll see as we're going through this cycle where your fundamentals will return again, those high quality companies will differentiate themselves relative to the poorer quality companies.
You are watching the Oasis Focus on Finance show. We're currently discussing financial markets with our special guests, Hassan Motala and Ebrahim. We'll be back after this break.